Elon Musk is preparing the largest initial public offering in human history. The target valuation for SpaceX is a staggering $1.75 trillion. At that price tag, the company would be worth more than every American defense contractor combined. It would exceed the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks, all put together. This diagram illustrates the core problem with the offering. On one side, we have this towering valuation, but on the other, the reality. SpaceX is actually losing roughly $5 billion every single year. Sustaining a nearly $2 trillion valuation for a company burning billions requires a massive, reliable source of capital to absorb those annual losses. If you are wondering who is buying an unprofitable company at the highest valuation in history, the answer is likely you. Within a few weeks, ordinary retirement accounts are set to become the biggest buyers of SpaceX stock. This will happen whether you choose to participate or not. If you hold a standard 401k or a passive stock index fund, the mechanical rules of those investments will automatically execute the purchase on your behalf. This mandatory buying is possible because of a recent, very quiet rewrite of Nasdaq's listing requirements, designed specifically to ensure this exact transaction takes place. This IPO functions as a highly engineered financial mechanism, routing the risks of a top-heavy conglomerate directly into the portfolios of passive retail investors. Most people picture this when they hear the name SpaceX, but rocket launches generated roughly $4 billion last year, accounting for barely a quarter of the company's total revenue. The division actually paying the bills is Starlink, a satellite internet provider that has become the fastest-scaling telecom company in history. This line chart tracks Starlink's performance. The provider alone accounted for 61% of total revenue. More importantly, its profit margins expanded from 41% to 63% in just 2 years. Combined, the rocket business and Starlink generated an $8 billion profit last year. Beneath the space exploration branding, the core of SpaceX operates as an efficient, cash-printing internet provider. But then there is the third business stacked inside the conglomerate. Recently, SpaceX acquired Elon Musk's artificial intelligence venture, xAI, in an all-stock deal that valued the AI lab at $250 billion. By March of this year, xAI was burning through more than $1 billion a month. Compounding the financial drain, every single one of its 11 original co-founders walked out, leaving behind an asset that Musk admitted had to be rebuilt from scratch. This bar chart compares the major players in the AI space. While OpenAI generates around $24 billion annually and Anthropic brings in over $30 billion, xAI produces an estimated $1 billion in revenue while carrying a $250 billion price tag. These losses entirely consume the $8 billion profit generated by Starlink and the rockets, dragging the consolidated company down to nearly a $5 billion annual loss. The SpaceX IPO effectively uses a successful rocket brand as a vehicle to offload an expensive, cash-burning AI asset onto the public markets. Pushing this $5 billion deficit onto the public market depends on a specific set of changes to the rules of the stock market itself. On May 1st, Nasdaq adopted the Fast Entry rule. It compresses the mandatory 3-month waiting period for a newly listed company to join the Nasdaq 100 index down to just 15 trading days, removing the standard period of market price discovery. Next, they removed the minimum free float requirement. A company used to need at least 10% of its shares available for the public to buy and sell. SpaceX is targeting a float of just 4 to 5%, allowing them to list while keeping the vast majority of their shares locked up. Finally, the technical language of the new rules includes a multiplier for low-float stocks. For any company with a public float under 20%, Nasdaq now treats those shares as if they were 3 times more numerous than they actually are. Nasdaq adjusted its own listing requirements to clear the runway for a specific class of top-heavy, unprofitable companies to enter the index. This flowchart illustrates exactly how manufactured demand works. There are more than 200 investment products with over $600 billion in assets that directly track the Nasdaq 100 index. Once a company is added to that index, the mechanics of passive investing strip away all human oversight. The funds are mathematically required to purchase the stock without any assessment of its fundamental value. This creates a specific timeline for the company. Everyday passive buyers are pulled in early at peak valuation, creating artificial demand. Meanwhile, corporate insiders wait for their shares to unlock so they can sell into that demand. The mechanics of the financial system have been restructured to use the retirement accounts of working people as a safety net for early investors. While most initial public offerings allocate between 5 and 10% of their shares to retail investors, SpaceX is targeting an unprecedented 30% allocation specifically for the public. The company's CFO framed this to a room of bankers as a reward for the loyalty of retail buyers. Translated out of corporate speak, this is a strategy to distribute overvalued supply to the widest possible base of buyers. Passive investing was originally sold to the public as a safe, low-fee way to avoid the risks of stock picking by simply owning a diverse piece of the market. But the exact automation that makes index funds effortless also functions as a guaranteed purchase order, providing an exit for early investors at the expense of the passive index holder.